This is the second in a short series where I look at what the impacts on investments might be depending on the choices the world makes in the next year or two. The last 40 years has been really positive for investments because we've had great trends that have persisted. Lower and lower inflation and lower interest rates, globalization of capital and goods increasing every year, and population growth, especially of the working age population because of great demographics in the East and the West. Now, for various reasons, a lot of these trends are reversing, and actually we're seeing emerging inflationary pressures, and for the first time in a long time, the world's going to have to make a choice as to whether it prioritizes inflation reduction or growth. Last month, I talked about what would happen if the world prioritizes inflation reduction, and today I'm going to look at growth. Prioritizing growth in practice means actively trying to avoid a recession. So making sure interest rates don't go so high that we have a large recession and all of the associated unemployment and wage growth issues. So politically, normally, it'd be quite popular if we do this. But why do governments sometimes choose not to do it? It's because inflation comes with three problems. The first is when you have higher inflation for longer, it tends not to be stable. It tends to go through periods of sharp increases and sharp decreases. And that uncertainty is bad for business investment, which has a long-term economic impact. It's also quite bad for investor psychology. Equity markets and stock markets don't tend to like it. So that ultimately has an impact on economies as well. The second thing is with any choice in this area, you're going to have political impact. So if you choose inflation, then it's going to be bad for people on fixed income. So it tends to be bad for retired and older people. But it's good for people who have borrowings, because if you have borrowings, you can pay them off ultimately later with money that's reduced in value. So the borrowings cost you less. So very simply, it's probably bad for older people and good for younger people. Clearly, that's political. And the last thing, and the major reason that policymakers tend not to like inflationary periods, is if you allow them to persist for too long, they become embedded in the psychology of the average person. And ultimately, the cost of ridding the system of inflation in the long term rises. So those are the reasons why people don't like inflation. Clearly, the reason politically why quite often it's attractive to choose growth is it's good for economic growth, really good for inflation and employment, and I guess good for the average person. So at this point, we still don't know which direction the world's going to choose, but it could reasonably choose either of them. So if the world does choose to prioritize growth and not to tackle inflation, then growth probably will be higher over the medium to long term than it would otherwise be. However, it will be higher because we've let inflation run. Now, normally, we associate strong economies with strong investment returns. But actually, if one of the aspects of the strength is inflation, the investment returns can be quite disappointing, and that's what I expect would happen in this scenario. So if you think about the two parts of someone's average investment portfolio, first part is bonds. Now, bonds have fixed interest payments. That's one of their characteristics. The value of these fixed interest payments varies depending on what interest rates are. So the lower interest rates are, the higher the value of any fixed payment in the future is. And the higher interest rates are, the less the value of it is. So in a world where we have higher inflation and higher interest rates over the longer term, actually bond returns would be less attractive. So bonds wouldn't do as well. The second half of the portfolio is, of course, the stock market. Now, strong economic growth normally leads to strong stock market returns. However, the uncertainty that comes with inflation, stock market investors haven't historically liked that. And I wouldn't expect they'd like that in this time either. So normally valuations come down and stock market returns in the short to medium term are actually quite disappointing. So if the world does choose inflation rather than tackling inflation, I'd expect stock market returns in the short to medium return period to not be good either. So if we choose inflation, my view is that total portfolio returns would be less attractive than they would be if we chose to tackle it and went for lower growth. As I mentioned last month, we don't think you can tell yet which direction the world's going to choose, whether it prioritizes growth or inflation reduction. The impacts on investments are going to be quite different. So taking a big position today and assuming the world's going to go one way or the other, we think is a mistake. So it's really important to be diversified and effectively to have a foot in both camps. And this gives you the best chance of making sure you preserve your wealth and you don't make a mistake. So for now, I think it's prudent to have a foot in both camps and to be well diversified. As always today, I must remind you that we've been talking about investments, so your capital is at risk. If you like these videos and you'd like to automatically see them, please click on the flying colours icon. And if you have any questions about anything I've talked about, please don't hesitate to get in touch. Thank you.